Welcome to the Banking with Life podcast. This is our Q&A series where I answer your questions regarding the infinite banking concept, becoming your own banker. Let's get started. In this question, the gentleman asked, if you have a certain future expense coming, is there a time frame between sending funds to a policy and making the withdrawal to pay for that expense? At which point would it not make sense to send the funds in the first place? So absolutely a timing issue. Every kind of purchase or financing opportunity is different. Everyone's timelines are different. But I would say this, that if you have the funds, if you have the money to pay a premium or to make a loan repayment, you should make the loan repayments as soon as possible, as soon as you have the ability to do so. And you should make premium payments, of course, on time. But if you have like unscheduled or flexible PUA riders where you can pay an additional PUA premium between the billing dates, I say pay it as soon as possible. Okay. Now, when I pay a premium or when I make a loan repayment, typically those funds are not available for 30 calendar days or 20 business days. And every company is a little bit different. Now, if I already have cash value, let's say I have $10,000 in cash value and I make a $5,000 loan repayment or a $5,000 PUA payment, I can still borrow $5,000 from the life insurance company because I already had $10,000 in cash value before I sent the additional funds, either premium or loan repayment. So you got to give the life insurance company time to process a loan request, and you got to give them time for the funds to actually transfer from your bank to their bank. It takes longer for them sometimes because they're still trying to get into the 21st century. Okay. Well, he continues. Example, I collect a real estate commission that will cover property taxes on one or more investments. If I want to pay as early as possible, say late September or early October, does it make sense from a banking perspective to send it to the policy in August? What if I wait to pay until December or January? And I appreciate you. I appreciate you, and I appreciate the question. So I would say, in addition to the kind of a carryover from the last question, if I have a premium due and I have the ability to pay it, I want to pay it as soon as possible. All right, there is still the time value of money that exists in everything financial. Okay. And then companies credit dividends differently. So if I pay, a PUA premium in the first month of the calendar year, I'm going to get a full dividend for that additional PUA premium that I paid. Where if I pay it in maybe the last 2 weeks of the policy year, I may not get a full dividend credit to that. Now that's minor and minute, but over a lifetime, it can make a difference. And then it's still good discipline and good practice. Your money should have a job. You should allocate where your money and your cash flows are going to and coming from, right? And they need discipline. So if a premium is due, pay it. If you have the ability to pay a PUA premium, pay it. Now, when Uncle Guido, the tax collector, wants his money, I'm not going to get a discount for paying him early. Crickets, right? So, and I'm not sure what state you're in, but property taxes may be due on December 31st or January 31st. I'm going to pay them on the dang day before they're due. I know what to do with capital. They do not. My opinion. So I would get the money into the policy as soon as I had the opportunity, and I'm going to pay Uncle Guido the last dang day I can. Just me personally, okay? But generally, if you have a premium due, pay it. If you have a loan repayment or a loan balance, pay it. With your outstanding loan balance, you're being charged interest. We cannot get around this idea of interest. You either pay interest when you formally finance, or you give up interest you could have otherwise earned by paying cash. That applies here too. So if I borrow money from the life insurance company, yes, my cash value is still going to be in the policy, right, and earning dividends and doing what it's supposed to do. I'm collateralizing that cash value, borrowing the life insurance company's money, and they're going to charge me an interest rate, and rightly so. So the less interest or the least amount of interest that they charge me, I'm okay with that. I don't want to pay interest anywhere. But if I have to pay interest, I want to pay interest to the life insurance company. And then if I have this room in the PUA, I'm going to pay additional interest, quote unquote, which is I'm calling that interest on the deal. All right. It is premium to the life insurance company if I have room to pay premium right into the PUA. If the PUA is full and the life insurance company is charging me 5 and I'm repaying it at 10, then I'm just going to shorten the duration of that outstanding loan. I'm going to accelerate the mortgage period, right? So I'm going to pay less interest. So it's preference though. Now, if I have to give the life insurance company 30 days before I have access to that capital that I need, right? Say I have a modest cash value and I make a premium payment, PUA payment, or a loan repayment of, 10, 5,000, 15, whatever number it is, but I need that money to go make another purchase. That 30-day timeline that I'm allowing the life insurance company to process those funds appropriately is in place. So if I'm going to miss a deal, like if I'm going to go buy a car, we've negotiated the price, I'm going to have a policy loan outstanding before the negotiations. If I know I'm going to go buy a car, and I'm sometimes impulsive, I might buy the car right then when I just intended to go drive it and look at it. So if I'm going to purchase a real estate property, or there's any kind of a real estate deal, there's a time element involved in that. I want the funds readily available in my personal checking account or business checking account before I enter in the deal. So I will borrow from the life insurance company. Yes, they're going to charge me interest. That money is going to go right into my operating account, and then I'm ready to go make the purchase. Right. Look, cash is king. I don't care what anybody says. And then timing. The first one to the deal with cash wins. Prove me wrong. That's just me, but good questions, and I hope that helps. This gentleman asks, as a general rule of thumb, what role should an annuity play in my IBC career? When should one start planning on utilizing this valuable asset? I appreciate the question, and I appreciate your classification of valuable asset applied to annuities. Annuities are extremely polarizing in the big wide world. People love them or hate them. It's almost like life insurance. People either love it or hate it. And I don't know who hurt these people and why they hate things so much. I don't know. But I appreciate you seeing the value in an annuity. An annuity is a life insurance contract, and there are many forms of annuities, or fixed annuities, variable annuities. But the essence of an annuity is an income stream, a lifetime income stream that you cannot outlive. Now, that's very broad, and to speak specifically about annuities in an individual case, you need to be working closely with an agent or advisor that understands annuities and understands you and what you're trying to do. So generally, to your question, I would say, since you have an IBC career, That means that you're participating in the infinite banking concept. And I would personally endeavor to use up my insurability. I'm going to buy life insurance until the life insurance company tells me I cannot have it. And that day's coming for all of us. It's a matter of time. And I hope it's a long time for you and me as well. So once they tell me, no, I can't buy life insurance, which would primarily be due to health reasons. If I purchased an annuity, there is no health component to that application. I just have to be able to pay the premium, because when you put money into an annuity, it is a premium because it's a life insurance company product. I don't have to go through health underwriting. Okay. Now, I see many cases where you have young people that wouldn't normally consider purchasing an annuity, but it may be in particular accounts or positioned in such a way they can't get to it anyway for a long time, and doesn't make sense for them to take it out and start infinite banking or what have you. I have clients as young as 40 and even under 40 that have engaged in annuity purchasing. But there's a primary specific purpose for that, right? And it is generally for future income. Then an older client, maybe I'm taking all of my assets and now I'm generating income, whether it's life insurance, real estate, or whatever it is, your qualified retirement plans. There would be a potential case or place for an annuity to guarantee income for, yourself and your spouse, or yourself or your spouse. So it could be really at any time, but the primary purpose of an annuity is to throw off a lifetime income. Now, if I purchased annuities when I was younger and I've got an infinite banking career and I'm fully insured, that income from an annuity, if I need it, I'm going to spend it. If I don't need it, the gains are taxable on an annuity if it's non-qualified. If it is in an IRA or a qualified retirement plan of any type, other than a Roth, then it is all taxable on the distribution. So just think through this. Okay, I don't want to pay a premium forever anyway, right? Is what most people think when it comes to infinite banking concept. It takes a little bit of thinking through that, right, to get past that and to be okay with paying a premium for a long time. So let's just say I purchased an annuity and I'm going into passive income time. I could turn on that annuity, have taxes paid on it, and then I get a net amount. That net amount can go into a policy as a premium. And then I'm telling you, if you practice the infinite banking concept and you have original illustrations or illustrations that you can put your hands on, you look at what a premium does when you pay a premium in your 60s or 70s, and then look at the increase in cash value and the death benefit. If you look at the increase in cash value, it will more than overcome typically than the cost of the taxes that you paid. Okay. So there's a lot there. And I think that you should be aware of all of your options in retirement or in income planning, and annuities can be a very powerful tool. Just don't be, hate or love annuities. They're just so polarizing, right? The investment guru that wants all your money in the market, he's going to beat up the annuity, and the whomever's recommending or promoting annuities, just like the annuity promoter and I don't mean that in a negative way or derogatory way, but the individual that their practice is primarily in annuities for retirement income or what have you. They want to overly beat up the market, or they want to overly beat up life insurance. So my point is, I think there's a place for all financial products and opportunities. You should be educated and comfortable with what you're doing and what you own, the assets that you own, and then kind of disengage from that polarizing activity. So I hope that helps you, and thank you very much for the question. This question is, James, wouldn't it be prudent to diversify one's financial system with both qualified accounts invested in diversified equities and a banking system? This is the approach I take. Well, God bless you. I do not give financial advice to the big wide world. I give financial advice to my clients specifically. So I'll leave it at that. If you choose to diversify in assets and asset classes, God bless you. Would it be prudent? I don't think it's imprudent, right? If putting your money in, you said qualified accounts. So, let me think that through. Would I rather pay a life insurance premium with after-tax dollars or tax deferred dollars? But it doesn't. You don't specifically differentiate between Roth or traditional qualified accounts. So, an IRA, a traditional qualified account just means that I am making investments with pre-tax dollars. So I'm deferring the taxes on my contribution. Okay. And then, I produced, 2013. So it's 11 years old. I produced a Banking with Life DVD on the 100-year anniversary of the Federal Reserve. We released it in 2013. So, and I go into great detail on qualified accounts. I think I have a module that talks about qualified accounts and the different characteristics of qualified accounts, getting a tax deduction today, postponing the tax calculation, who knows what tax bracket we're going to be in the future. And then I don't have access to that money, or I do have very limited access to that capital over the whole duration of the account's life. So let me say this, it could be prudent and it may or may not be prudent. It depends on you specifically and your individual circumstances. I personally prefer to pay taxes in a known bracket and pay only what I owe and no more. And of course, taxation is theft of private property by force. So I don't really agree with taxes. I know who's going to build the roads, who's going to take care of the children. I get it. The same people that do today. Okay. But I get it. We've got a lot of countries we're supporting. We got a lot of people we're supporting. And if I just continue down this vein, right, while I'm practicing grace, the gentleman, it was on YouTube. Okay. So let me ask you this. And the listener, if the government can print all of the money that they wish to, or let me ask that question. Can the government print all the money they wish to? Well, apparently that's what they do. Well, if they can do that, if they can print all of the money that they want to, why do they need my money? Why do they need your money through taxation? I don't know either. I got a pretty dang good idea though. Okay. So let me go back to the question. It may be prudent. It may not be prudent. It depends on your individual circumstances, current situation, future goals, and, knowing that the future is unexpected. So thanks for asking and allowing me to go through that. In this question, when does interest begin to accrue on policy loans? In parentheses, in advance or in arrears? Question mark. And then he asked, does a specific company charge a fixed interest rate or a variable on policy loans? And then what is that rate currently? And then how do policy loan repayments work to pay down principal and interest? It seems like there's been a lot of policy loan and interest questions. Okay. So when does the interest begin to accrue on a policy loan? The day you borrow, day one. If I borrow $10,000 today, interest charges start today. Now, how do they bill for it? How do they account for it in advance or in arrears? Some companies offset reserve up front an amount that functions in several ways to prevent a lapse, to prevent overloan. But interest accrues day one. And then as you make loan repayments, there's either a refund of interest, right? Or the loan balance recalculates. So if I borrow $10,000 today, I'm paying interest from day one. It's an annual interest rate. You just take, so on a $10,000 loan, 5% interest rate, $500 in interest, and divide that up by 365 days. That's the daily interest rate that I'm going to be charged. Now, if I go forward and make a loan repayment in 10 days, the company's either going to refund me the difference of the interest that I was charged because the $10,000 was not outstanding over the whole 12-month time period. So it's an annual interest rate, accrued daily, charged day, begins day one, or the company may reduce the loan balance when I paid the loan repayment, and therefore I'm still being charged the interest rate on a daily basis, but it's on a lesser amount. Right. So it's how they do the accounting. You're paying interest every day you have an outstanding loan. I don't care how they do the accounting, in advance or in arrears. So that's a pretty good question. They were all great questions. Thank you for listening. Thank you for listening. If you have a question that you would like answered, email me at james@bankingwithlife.com. Thank you for listening. Have a great day, and we'll see you next time.